we are watching, in my opinion, the next stage of gambling the entire system, the eventual, for maintaining the existing Ponzi, basically, which is Treasury purchases. There is no one with $1 trillion every 2 months. Nobody has that kind of income. Even China, with all its trade, doesn't have the means. I think they topped out in total around $1 trillion, and they sub $1 trillion today on all-time accumulation of treasuries. And there's a new trillion every 2 months. So who's been the buyer? Well, we also had the French and the UK. I call them the slave nations that are tied to the post of the Western hegemony. The only thing that's good for the collapse for America is that they won't be alone, because they're going to drag down the entire Western world that is bought into the same Ponzi.
In this episode, we open with a careful, high-level look at the stress points Francis Hunt has been tracking in the heart of the global financial plumbing: the Treasury market and the short-term funding system that underpins it. Hunt's argument rests on an accumulation of unusual market mechanics: a crowded, highly leveraged basis trade, extreme reliance on repo funding, and recent anomalies in reverse repo and Treasury demand, which together create vulnerabilities no longer contained to a single market. Over the coming minutes, we'll introduce those threads, explain why they matter to capital markets at large, and then let Hunt's own analysis take you deeper with the interview clips that follow. Hunt paints a picture of a system that has, incrementally and invisibly, become reliant on a steady, very large marginal buyer of U.S. debt, a buyer financed through overnight repo and similar short-term arrangements, to keep yields artificially low and to sustain the scale of government financing that modern fiscal policy now requires. The natural logic of that arrangement is fragile. When funding becomes scarce, haircuts widen, or counterparties question collateral values. The leverage that magnified returns can just as quickly magnify losses. Those dynamics are the core of the basis trade vulnerability Hunt describes. Hunt is concerned that recent dislocations in reverse repo and comfortable Treasury bidding masks stress rather than signals health. A robust headline auction tells one story, but behind the scenes, the ownership data, counterparty concentration, and repo plumbing suggest a different one. When you combine year-over-year increases in outstanding debt, record repo usage to finance Treasury positions, and the outsized holdings reported in jurisdictions and vehicles that do not behave like standard sovereign buyers, the risk profile changes from market correction to systemic stress point. This episode is about understanding why that difference matters for investors who must weigh capital preservation against speculative return. Throughout the interview, you'll hear Hunt connect that plumbing to real-world consequences: margin calls that cascade, futures and cash markets that decouple temporarily, and the potential for the central bank to face a painful choice between market rescue and inflationary consequences. His thesis is not a simple doomsday claim. It is a chain of operational and balance sheet facts that, when combined, materially increase the likelihood of sharp, nonlinear moves across fixed income, currency, and precious metals. Keep that framework in mind as we shift into the clips. Think in terms of funding, leverage, concentration, and the channels through which stress transmits into prices. After these first clips, we'll unpack the technical markers Hunt references and overlay them with price behavior in gold and silver. Because while the story is fundamentally about leverage and funding, its clearest market signal has been pronounced moves in precious metals. If you want the follow-along charts and a concise checklist you can use to monitor this theme in real time, hit subscribe and the bell. And if you find the analysis valuable, share the video so other investors can judge the implications for themselves.
I have my suspicions, as much as I don't wish any ill on America. I have my suspicions surrounding people that comment about a great auction for treasuries again today. You get a lot of this, all these people talking about, the dollar's under threat. Look how well demanded the treasuries have been, et cetera, et cetera. And there's been recent revelations, but it's worth also putting why these recent revelations have come out. There was an event in April that was very specific to the gold market, and I'll tie all this back to gold because I don't want people to think that we're just going on a journey in the wilderness here. This is a gold story in the end, and a silver story, very, very strongly so. In April, at what we called and named peak Trump tariff tantrum, which was when the very first time he was getting super aggressive and levied triple-digit type tariffs across the broad spectrum of nations, but the ones on China being probably the most significant due to the trade relationship that is held there. We ended up getting an event that saw Treasury spike down in value, rates spike disproportionately up. And I will show you that event on the charts when we refer to the technical section in the second half of our chat. But I want to put that landmark for everyone to remember. And of course, what also happened, which brings us back to gold, and I will be tying, once I've taken you for a little bit of a walk in the wilderness, I'll be tying this all back. Gold ran, having done our target of 2,900 and 3,000 that we had suggested when we were down at 2,000 on your channel. Gold had a surge from the 2,900, smashed right up to 3,500, and that was its peak. And then we got put into an April till September continuation pattern that recently broke out and led to the 3,350 runs right the way through for another $1,000 to the high end of 4,350s. And since then, we're having our pullback. But going back to that April moment that was super, super violent, what was really behind that? We called it peak Trump tariff tantrum. And the great irony about that is Donald Trump came out and said, without being prompted, I don't know how this came out, but ended up saying, we weren't worried about the bond market. Now, what's happened since then is the Bank of International Settlements, which for those that aren't familiar is a Swiss-based central bank to all central banks, highlighted that there is a crowding out and real systemic risk brought about by a very crowded trade, a very highly leveraged crowded trade. And that trade is what's known as the basis trade. So a top line, everyday man's explanation of the basis trade without losing ourselves too much in fin speak and gobbledygook jargon is basically the following. Leveraged hedge funds buy treasuries. They do so with great leverage. So they're typically putting 1% and 2% maximum down. They are being levered up, essentially 100x, and are holding this. They are then pledging it as collateral, and then they are securing further leverage. They are shorting the futures markets, which typically trade higher than futures are basically, particularly on bonds. It's just fiat, but it's fiat with a delayed delivery. So it's all about fiat. Even debt markets aren't really debt markets, they're fiat markets. We say we merge the two back together. They're Siamese twins, but they're one and the same. But it's just delayed delivery fiat. A bond. That's all it is with a maintenance cost. So in essence, they are shorting futures on the basis by the time the expiry comes, the futures typically come back down and meet spot on delivery day. There's no point in buying a more expensive future for delivery the same day if you can buy a spot cheaper. So invariably they come down. So they're shorting the higher line that comes down and buying the undervalued asset. So many will say, well, technically they hedged because they're long the same assets that they are short. The problem comes in is most markets have what's called contango. That means the future delivery costs more than the present ownership. There's in things like gold and oil, obviously there's storage costs. When you're talking about paper money that is all digitized, it's more about opportunity cost and also interest rate costs and maybe a little bit of inflation that creeps in there. As well being priced in. So they are getting a very meager return. It's not a great trade, particularly. It's a very meager return. How do you maximize a meager return? You apply a huge amount of leverage on it. But there's also costs. And in the financial running of this basis trade system, they are pledging the collateral. They're even letting go of ownership for it for a while and financing with the repo markets, which brings in the intricate plumbing. Repo markets are the interbank lending, where excess deposits can be lent to other banks at a low liquidity levels overnight just to shore up a short-term cash need. So you have all of this interbank plumbing that typically doesn't affect you and me in the streets. Of course, it also extends into money markets. Now, just an aside, not specific to the basis trade, Warren Buffett is getting a lot of attention for having one of the biggest holdings in the money markets. I think he has in excess of 300 billion in the money markets, where he's earning around 4, possibly a bit more. percent on that on an ongoing basis because he's unhappy with equity valuations. So he is providing liquidity technically via the money markets for interbank lending. His bank can make up those excess deposits available to other banks that might be short. And all of this is a funding mechanism for aggressively levered through the primary dealers who are facilitating the hedge funds for putting this trade on. And I compare this to subprime. The only differences is subprime, you and I as man in the street got to see. We had a friend at the dinner table who had 10 apartments but didn't have the money for one. He just put a good faith deposit, a very menial one down. Some had even got 100% finance or even beyond 100% finance. We could see there was something odd going on. Is all inside the bowels of institutional banking, primary dealers, repo markets, money markets that most people don't understand. And there is excess leverage building up there that's likely to cause a repo crisis or a money market crisis. And this is so systemic. The point of BIS that brought this out about what's going on in the treasuries are truly held by the Cayman Island, and saw that an already big whale in treasuries was understated by was only 25% of the position they truly had, the true value.
Picking up from Hunt's first main timestamp, the most actionable takeaway is the way in which a crowded basis trade amplifies ordinary issuance into acute liquidity demand. When asset managers and leveraged funds buy treasuries with scant cash down, and then pledge those positions as collateral to obtain further repo financing, the system's margin of safety evaporates. This structure means that a rise in short-term funding costs, even if modest in absolute terms, produces disproportionate strain on participants that are levered 30 times, 50 times or more. An incremental uptick in repo haircuts converts a historically stable spread into an immediate cash call event. For practitioners, that mechanism is simple to monitor. Watch repo rates, reported haircut changes, and the distribution of treasury holdings across custodial jurisdictions. Widening repo, tightening haircuts, or highly concentrated holdings are early, quantifiable red flags. Those same mechanics are why Hunt ties the liquidity story back to gold and silver. When leveraged margin stacks are threatened, counterparties deleverage by selling what can move first, often cash treasuries or futures positions, and liquidity premiums reappear in safe haven assets. The net effect is twofold for precious metals investors. In times of acute stress, price spikes can be rapid and violent as liquidity hedges are established. Over the longer arc, persistent systemic fragility and rising sovereign debt issuance create a backdrop where real, physical demand for gold and silver can increase as confidence in fiat plumbing declines. Thus, short-term pullbacks in the metals do not invalidate the structural bullish case. Instead, they often represent consolidation phases within a broader regime change toward higher long-term real prices.
So here you have a tiny Caribbean island. You're talking about a speck of an island that has 7.1 billion as of 2023 GDP. Now let's just say 7.1 billion GDP is the equivalent to a man's income for a year. If you were on 250,000 a year, Elijah, you would have, and you were the Cayman Islands, so your 250,000 is equivalent to 7.13 billion. They have 1.8 trillion in US Treasury exposure. That would be the same as you, with your $250,000 annual gross salary, having 68 million bond portfolio. Now, I think you would be thinking that if you were on that income, you might have a bit of gold, you might have a silver. It would be quite unlikely that you'd be deep in the 7 digits on anything on $250,000. You have a bond to pay, you have other expenses, etc., on $250,000. But 68 million bond portfolio is deeply improbable with that level of income. That is the scale to which the Cayman Islands has become this bottomless pit buyer of what I consider to be Ponzi-onomics, which is 1 trillion every 2 months. We've just crossed into 38. It was 2 months ago, we crossed into 37, and it's escalating. We will be 40 trillion before the year end. It starts with a 4. And who are these big buyers? They are being financed by repos, overnight, daily repo funding and the money market system. And it's a crowded trade. And all you need is for futures to go into backwardization instead of contango. They are so leveraged and they consider it such a certainty, and they've all been jumping into the space and getting these returns. You just get the future move away from the cash markets, and they will not have the margin to hold it up. It becomes systemic, too big to fail. Fed has to stand in. It's a long-term capital markets parallel as well, because they put the entire system at risk, and therefore you create the next bailouts it's not even for retail. Socialized cost on the rest of us, major profits. The people who will gain out of this folly, though, and how do we ensure ourselves, is gold. The point at which we had this event in April, it's worth showing you what gold did when all of this had its wobble. That has led to all these recent exposures that we are now discussing. It was this period here that saw this huge run up. Doesn't look huge now, given what's happened since. But we had a surge from the 2.9s to 3.5, $600 on $2,900. That was literally a 20% move, and they quickly went into mini behind-the-scenes crisis. Many of people aren't even familiar that much was going on, but Trump did make that rather telling statement. Did you have concerns about the bond markets? It's worth also showing you what the benchmark US 10-year did, of which housing finance is so reliant on, Elijah. And that was this period. You should see it immediately pop. This was gold at 2,900, bang, gold at 3,500. And as much as there's been talk of cuts and everything is recessional and soft, which it is, in my opinion, you have yet to make the pre-basis trade wobble lows. We've been in a long, slow comeback with terrible news on employment. We've had some shocker non-farms. We didn't get a non-farm because of closure last month, but before it, we had 2 in a row, very, very hard hits. You've had Trump putting pressure on all of that. You've yet to get back to the rate level on 10-year treasuries that you were at here just prior to the basis trade wobble. So this just goes to show the sensitivity. And to complete this, I want to show also the Dixie, and then I'll hand back to you because this has been a long narrative that I've unloaded on you. But that was what happened to the dollar index during that same period. The harshest part of the adjustment, it had already started at March a little bit. You could see it as soon as we hit April. That was a very, very violent sell-off. Dollar went down, treasuries went down, rates spiked, gold, and this is a gold story. I told you I'd bring it back. 2,900, zip, suddenly 3,500. I am putting an amber light out there saying your next major financial crisis may have this theme on basis of what my research has shown me. And I'm not the only one, by the way. There's other people that you can follow that have picked up on this. And I did get some which profile was it? There it is. There's a gentleman here who's also been covering it, I think is worth. He's been putting it out, and I've been reading his takes on top of our Substack takes, and he's bang on. And the interesting thing is, this is a very useful formula. I like how he summarized this. The US government spending $2 trillion more than it collects. Yes. Hold on, where's the one I'm looking for? This is the key thing. The more bonds are issued, let me just put this in the pink box here so that it pops for everybody. The more bonds issued, the more leverage buying is needed through the basis trade. The more demand for repo loans, because they don't have the money to buy the bonds. There's such big amounts. They are hyper overvalued. They should be trading a lot less with much higher interest rates. The bubble and the controlled market is the debt markets, nothing else. And debt fiat is the foundation. Everybody wants to talk about stock markets and everything else. Those all sit like layers off of the foundation. The debt fiat system is the foundation. The more bonds issued, the more leverage buying, the more demand for repo loans. Upward pressure on short-term repo rates. That makes it very hard for rates to go a lot further down because you've got this liquidity suction that is being put on the repo markets. And that builds systemic risk. This part of this tweet as well, that the gentleman, Jeffrey, did put down, highlights that and I like some of the phrases. I'm just going to change glasses for the reading of it. This is the BIS. The government's bond markets at its center, and asset managers of various stripes as key intermediaries. As a result, the key risk today is liquidity stressing in government bond markets. Hedge funds in particular become key providers of pro-cyclical liquidity in government bonds markets, often employing high leverage relative value trading strategies by using government security as collateral in the repo market to borrow further. So haircuts have gone to zero. So haircuts are when you require a kind of a deposit. You take something. They've gone to zero and even negative. So you can actually pledge collateral and get more lending back.
Now we step back and situate the core claim. This is not simply a story about one failed auction or a single repricing event. It is a story about the interaction of fiscal scale, market structure, and financing techniques. When sovereign issuance crosses thresholds that cannot be absorbed by traditional, fully capitalized buyers, the market adapts through leverage and repo facilitation. That adaptation supports issuance in the short run, but it creates a fragile edifice. The greater the dependence on short-dated funding and on confined pools of collateralized buyers, the more the probability that a shock, policy, political, or technical, this has implications for asset allocation. First, liquidity is now a first-order risk. Investors should stress test portfolios for scenarios where funding dries and where traditionally liquid cash treasuries temporarily widen spreads or become functionally scarce. Second, counterparty exposure matters. The entities that intermediate leverage, primary dealers, large custodial chains, and shadow banking conduits, are the nodes through which systemic stress amplifies. Third, for long-term capital preservation, allocation to physical, deliverable precious metals provides a non-correlated ballast to liabilities that sit on fiat and repo plumbing. Critically, we should also accept a two-speed reality in markets. Price action in liquid paper, ETFs, futures, and highly traded treasuries can diverge from the physical market for hours, days, or even weeks when liquidity conditions deteriorate. Those divergences are not mere technical curiosities. They are the very cracks that reveal where forced sellers will move first. For disciplined investors, this means preparing for quick, tactical opportunities to increase exposure to physical metal during bouts of paper market weakness, while maintaining liquidity buffers and clear execution plans so that purchases are made at measured, operationally sound moments. Finally, a sober note on policy. Central banks and official entities increasingly sit between moral hazard and market stability. Hunt's thesis implies that the policy backstops we have relied on in past cycles may be less clean or more costly the next time they are deployed. That underwrites the case for real assets as an insurance policy. Not a speculative bet, but a prudential allocation chosen to preserve purchasing power when fiat anchors are tested. If you appreciated this analysis and want more like this, subscribe and click the bell so you don't miss any of our future uploads. Leave a comment with the single metric you'll be watching first: repo rates, treasury ownership concentration, or the paper-to-physical spreads in gold. Thanks for watching and see you in the next one.